where we bring, the idea is to bring great investors, great entrepreneurs, founders to come and speak to our audience, which includes seasoned investors, first-time investors, founders of our startups. And the idea is to learn from people who have done what they are trying to do successfully many times over. And in continuation with that, today it's our privilege and honor to have Mr. Rahul Bhasin, Managing Partner of Bearings India, to join us. Before I introduce Rahul, just want to let you know that Rahul is logging in from the hills, where he's currently, after probably taking a much needed some time off, but he was still kind enough to make an exception for IPV and come and speak to our investors and our founders. So Rahul, really appreciate it. And it is through the support of people like you that IPV today has become one of the largest CXO platform in the country, and we have had a fair share of investments. We are close to now 100 startups that we will fund, and we will reach that number very soon, as well as 10 plus exits with another 16 in follow on. So moving on to the next slide, as part of IPV, we are also building strong communities. We are fortunate to have both the alma maters of Rahul, SRCC, as well as IIM Ahmedabad here. We are running such communities for a lot of other top education institutions of the country. So if you want to join your respective university, please join the QR code. If you want your university or your school to become part of IPV, where we reach out to the alums, the professors, as well as the startups, please use the QR code again. Moving with this, let me introduce to you Rahul, who I had the privilege to meet in person a few weeks back, and was enthralled to know about his experience outside investing. Today, we'll keep it on investing, but I can tell you there is so much more to learn from him than just investing, about how he has, through his own perseverance and research, been able to, make some significant difference to health and so many other areas. But coming back to Rahul, an alumni of IIM Ahmedabad and SRCC, like I said, we are running the communities for both. He's currently the managing partner of Bearing Private Equity Partners India, as well as senior partner and global board member for Bearing Private Equity Partners International. In his capacity, he is also on the board of several large companies, has played a phenomenal role in the turnaround for Mphasis, and overseeing from a loss-making company into a large profit-making company with a current market cap in excess of $3 billion. And prior to Bearings, he and I shared at least something in common, where he was at Citi, and he was part of the asset allocation committee of Global Asset Management Group out of London. And prior to that, the youngest independent treasurer at Citibank for Northern India. He is here because he has been an active investor, has overlooked several investing cycles, can share with us how it is to build businesses and how to invest in businesses. With that, I hand it over to Mitesh and Rahul for a Ask Me Anything session. Thank you, Rahul, for joining us.
Thanks, Ankur. Thanks for handing over the reins to me, Ankur. Thank you so much for a lovely introduction. And I think anything said about Rahul is not going to be enough. So let the man speak for himself now. But just to add, and at the risk of sounding a reiterative, absolute pleasure to meet always Rahul, and a lot to learn from him. In our short history of knowing each other of almost, I think, less than a year now, where IPV has been working closely with Bearings team. And I've interacted with Rahul, at the most twice, but leaves a lot of impression. And the idea of this session came from those interactions where we felt that Rahul, for our investors as well as founders or wannabe founders who are on this call, will benefit immensely from your experience of your rich journey. And what an apt topic. We are going to talk about 4 decades of investing and learnings from them. So Rahul, if I can pick it up with that background, also going a bit into history, would you like to just tell something to our audience about your background? How did it all happen? Where did you grow up? How was your childhood like, and how did investment happen to you?
Well, thank you for inviting me and having me here. I will later on expound as to why you should not listen to people like me. But to start with, you asked about where I grew up. I was very fortunate to be born in Assam and lived to a tea planter, had a fabulous life, and basically had tons of lucky breaks. I think I was also very lucky that for a short period, I think by the time between the ages of 8 and 18, my father had turned an entrepreneur and went through difficult times. And therefore, I was his water boy, his accountant, his quality manager, his purchase manager, and for the most part, his mundu, if you all know what that means. But that gave me a big exposure to business and gave me an exposure to, a senior executive out of a corporate setup and how they worked and operated, which I think most people would not have had that opportunity. And then, by the time I was 17 or 18, he sorted itself out and started doing well again. And I was dismissed to go and study. But that was, very strong foundation. But investing for me started because of actually my paternal grandfather, who I was very, very close to, passed away when I was 8. And strangely, he left me some equity shares. They were in a company called Brook Bond.
Wow.
And because I was so close to my paternal grandfather, I was completely fascinated as to what this was. And it became almost an obsession for me. I started learning, and I think by the time I was 11 or 12, I think I learned how to read a P&L and a balance sheet.
Wow.
And then started keeping dummy portfolios. And for 2 years, I demonstrated to my father that that I could do better than what he was doing in the equity markets. And very grudgingly, he gave me 10,000 rupees at that point in time and said, "Do your worst." I speculated, got extraordinarily lucky, made some returns very quickly, returned his 10,000. And the journey for me has never stopped as far as that is concerned. I did that through college. It was very profitable and allowed me to get up to a lot of mischief, which otherwise I may not have been able to afford. It was just something which as a subject was fascinating for me. At various points in time, I ended up having to take P&L responsibility and operating roles, etc. in my career, but my fascination for investing and the whole process never left me.
Awesome. No, I'm sure what you're making it look like sounds so easy would not have been so easy. So maybe some more journeys as we go along would kind of ping you on that and would try to understand a little bit more about. But tell me, how has the investment scenario in your experience as a 12-year-old guy to somebody then who went to college and was maybe a little bit more experienced then, or somebody who joined Emphasis or somebody who joined City? How has it evolved? Where do you see, not only India, but globally also how things have evolved? And currently, when we talk about Sensex at being a senior citizen at 60,000 or startups euphoria, where a lot of money is coming into this segment, how do you read into this? Is this madness? Is this euphoria? Is this for real? Can you help us and our audience to kind of make some sense out of this?
So when I started out, actually accounts used to happen annually. And one, insight I developed very quickly was that if you track commodity companies and you simply keep an eye on commodity prices, you could predict profitability. And that was an extraordinarily profitable sort of exercise for me, because in those days, what used to happen was that stocks used to stay flat throughout the year. And, maybe 4 or 5 days before the results were announced, the stock would either rise significantly or drop significantly. That's basically once the accounts were consolidated, then people had a view that, oh my God, this is what the profits are. But if you simply tracked, and I used to live in Calcutta, my father had been in tea, I used to track the tea auction prices, which I found out very easily. I used to run and play rugby in the CCFC in the morning, and a lot of the tea guys used to be there, and they used to be discussing tea prices. And I used to keep overhearing these discussions on tea prices, so I knew where they were moving. So it was very easy to speculate on, tea companies at that point in time. You move that to steel, and Tata Steel was also headquartered in Calcutta. It also helped me. And I slowly figured that, once you track commodity prices, you can predict profitability and you can invest ahead of the cycle. Sadly, we've now moved to quarterly P&L, and everyone and his uncle knows this thematic and it's not so easy anymore. But I was very lucky at that point in my life that, that opportunity was there and I sort of took advantage of it. And then you just, over a little time, you just had to move to a little bit more specialized commodities like different kinds of chemicals, etc., which are not that well known and not well tracked. And the minute you figured out how to track that price easily and how to get hold of that data, again, profitability became very easy. If you knew where cotton prices were moving, you knew how the textile companies would make money, not make money. But I think one of the most important things which played a big role as far as all these things is concerned was an element of luck. And I was very lucky. I mean, things could have gone wrong very easily. During my college days, I mean, I think about it now and I think of the leverage I used to take, because in those days, there used to be Badla, etc. It was extraordinary how I didn't get burnt. And I still don't understand how brokers gave me the kind of credit lines and credit limits that they did. I mean, they should never have. I mean, it just is completely insane. But one of the things that I learned as a consequence of that was how to manage stop losses. Because when I had very little capital and I was using a lot of leverage, I knew that I could not afford to take a loss. So I very quickly got disciplined as to how to use stop losses and make sure that I don't get caught in a situation which would wipe me out. And that was and that sort of led me to the whole concept of figuring out market timing also, because it's not just necessary to get something right; it's also to understand when you pull the trigger, right? I mean, there are two different distinct features. But I have to confess that the real and I did very well in the again, when I joined Citigroup, I joined in the treasury, and again I was very lucky because you could make arbitrage profits in those days. If you track more than one market, and instead of just tracking the FX market, you actually track the swap market, the money market, the bond market, and the international markets, and you track track what swap rates were, and there was intrinsic borrowing and lending spreads inherent in those kinds of things. You could actually understand and price markets which were very inefficient. So they were, in essence, I would say, arbitrage profits available. And thankfully, my bosses, a lot of who were outside of India, never understood how you could sort of essentially arbitrage and make whichever budget they gave you fairly quickly. So I developed this totally undeserved and unearned reputation of being, very clever as far as markets were concerned, and I got promoted very quickly and got tremendous opportunities.
This would have been which year?
This was in 89, 90. I was sent in 89, when I just started my career. I remember they gave me a budget for 6 months, and I met that budget in the first month, and my bosses said, don't make any more money because they'll raise the budgets for us next year. So they sent me to Tokyo for training, and I think I spent 9 months in Tokyo, learned, as a consequence, I learned a hell of a lot more. But these are just, serendipity and a lot of lucky breaks, which just kept happening one after the other. But the really funny thing is that I developed a reputation for equity. I always thought I was very good at equity. But professionally, that was never recognized, and it got recognized for, again, complete serendipity, because what people didn't know was that I had booked a car and I needed money to pay for the car at that point in time. In those days, our salaries were very, very low, and most people will laugh at if they this thing as to what our salaries were. And I'd booked a Maruti car, I remember, and they raised the prices. So I needed money at that point in time. And, just before that Harshad Mehta scam, etc., I sold at the top of the market, and you have to get permissions before selling. So I literally timed the market perfectly. It had nothing to do with my insight on the market. It was just because I needed money. But that built my reputation as an equity investor. And after that, I just got one opportunity after another. So I think one should read this book by Taleb, Fooled by Randomness. Because a lot of what people earmark for skill and talent and insight is really all luck, right? And I think that you should be careful about this, because and not only this doesn't only apply to me, but it also applies to, I see a lot of people getting very lucky. They get onto the right trend at the right time, and I think the most dangerous thing is to actually believe that was something that you did right. And very often, you see people in the fund management profession over 4 years, 5 years, they'll do extraordinarily well. But if you dig down to why they did that well, if you just flip coins, out of 100 fund managers, one cycle, 50 will get right? 2 cycles, 25 out of 100 will get right. 3 cycles, it's 12.5% will still get it right. One more cycle, it's 6.25%. But just think how dangerous that is. I mean, someone can go through 4 cycles without having a clue about anything, but having got 4 things right consistently. So I think one should always sort of look in the mirror and reflect and say, did I really understand what I was doing when I made this money? And, was this serendipity, or, was this something that I actually got on to? And I think that's a very sort of important part of, I think the other issue to my mind, which is very big, and why I said that you shouldn't listen to people like me who have probably been in markets for odd decades, is I think we are probably burdened by too much pattern recognition and too much insight at a stage in our lives where things are structurally changing so dramatically. And the reason I say this is that, after the global financial crisis, the cost of capital has virtually gone to zero. Right. I mean, even today, there is almost $6 trillion of bond investments, and $6 trillion of bond investments, which today yield a negative return, right? So which means that people are paying to lend someone money, okay? Now, if you look at that, you look at data, which also, again, something which I should caution everybody, if you look at the VC industry, and you look at it in aggregate, if you look at the amount of money which goes into the VC industry, and you look at VC returns in aggregate, not the big names, not the newspaper headlines which are screaming out at you, but in aggregate, you will find that for most parts of the last 20 odd years, those returns have been zero, right? Which means, which is quite extraordinary. I mean, if you think about it, because there's such big winners, and which means that, and really, the analysis available of Silicon Valley more than anything else, if you look at it, it's roughly on average every year of all the investments made in venture firms around the world, it's roughly 15 which give you maybe 90% of all the returns made to venture around the world, right? So if you've gotten one of them, I think you need to be have a lot of self-belief to understand that you got that right simply by your skill. I think there is a lot of serendipity around that too. And the other real issue to me is, one, cost of money has been zero, so there's a lot of innovation. 2, if you think from a historical perspective, there are more engineers and PhDs working today. I would say that 90% of all the engineers and PhDs that have ever worked are working today, right? Now, you take these 2 things and juxtapose them, free cost of capital and this kind of disruptive, innovative ecosystem which prevails and has now been spreading. You add that to the fact that you have now, there are various investment theories about when one makes money. There's the sort of installation phase of new technology adoption, and then there is the scaling up or the deployment phase. And people suffer and get burdened in the installation phase because a lot of people tinker around with things, but that never makes money. But it's really in the deployment phase that you make money. Now, the issue and challenge is that people who've been around a long time often get caught up in the installation phase. So they've seen that happening for a while. And then they say, been there, seen this movie. And just at the inflection point, they miss that investment. And that's a very big risk, which if you think about. And the real challenge and the very difficult thing really is figuring out when the timing is right. If I ask everyone that, when was optic fiber adopted, and when was the first time optic fiber was adopted? Very few people would know the right answer. The right answer is it was the first optic fiber network which was laid anywhere in the world was in 1840 in Paris, right? But when has it got commercialized, scaled up, and become a big business? More than 100 years later, right? Similarly, I mean, if you think about it, everyone says that Apple was really made by the smartphone, and that's when it became really big. That was 2007. That's when it took off. All that is true. But were they the first people to come out with a smartphone? No, IBM launched theirs in 1997. It disappeared without a trace. But IBM was not the first, and IBM spent 20 years before they launched their smartphone. They were not the first. The first smartphone was launched in, I think it was 1982. Radio Shack launched a smartphone, and you know how many they sold? 4.
Wow.
Now, problem with investors like myself is that we would know that this happened, right? And you would know that these 2 guys failed. So that when the technology is mature enough and you're actually going to hit that inflection point where all of the things come right, because it's not just dependent on a industry, it's a lot of other industries, improvements and aggregate, which are bundled to form a product or service, which is then disruptive, right? But if you've seen that movie too early, it's kind of dangerous. So I'm not sure that there's such an advantage of having been around. I think, being ignorant and sort of having a fresh perspective has its value. So don't discount that is my strong right? The other thing that I feel very, is that if you look today around the world and you look at the different industries, the extent to which they're going to be transformed in the next 10 years or 20 years at a very fundamental level is so high that I think you've got to approach most things by first principles and not simply sort of go by, this didn't work in the past, so I shouldn't look at it. I know personally 30 companies which have tried to replace the doctor in diagnosing diseases, right? And I can sort of iterate for you, this guy did it, didn't work, this guy did it, didn't work, this guy did it, didn't work. But I can also sit here and tell you that one day it will work. And that predictive model will be far better than any human doctor. Now, the issue and challenge is that how do you know when? How do you know, And so I think what's very important in this kind of investing is to not walk into any meeting with a preconceived notion that, I know this doesn't work, right? It's a very different thing that at a meeting, right? You might challenge the entrepreneur and say, you know what, all this has happened, doesn't work. And a lot of entrepreneurs will sort of get defensive about it and walk away. And frankly, I'm fine with that, because that's the kind of entrepreneur you should never back, because the kind of entrepreneur who wins is the guy who will sort of turn around and look at you and say, you stupid guy, I've been working on this for bloody 20 years and you've listened to me for 5 minutes and you're telling me it doesn't work. You need to succeed as an entrepreneur, you need that courage of conviction, right? I mean, and sort of often people like ourselves are just testing whether somebody has that courage of conviction or not. Because if they don't have that courage of conviction, then everybody will push them around. And you cannot disrupt markets. The other thing to my mind is the whole concept, if you think, is that there's always this thought process and this troubling thing which always everybody faces, that every industry has incumbents. The incumbents have big balance sheets, right? They have a big business, and they are these startups. How do you know when the incumbent will win and when the startup will win? It's something that you need to really think about deeply, because if you think about that superficially, you'll get that answer wrong. Most of the time, the incumbent typically is innovating. He's got innovation. He usually doesn't have brand, distribution, etc. The incumbent has brand and distribution, usually lacks innovation.
Correct.
So I think the core part of it is figuring out whether the incumbent will get the innovation quickly or whether the disruptor will get the distribution quickly, right? And The crux of that matter, to my mind, is in a lot of, you have to find out how fundamental that disruption is. Is that incremental? Because if it's incremental, the incumbent will win. If it is truly something new and disruptive, usually it's the disruptor who will win, right? And I sort of would draw a parallel, just as an example, that if you look at Tesla today is worth more than all of the 10 biggest auto companies after it put together in terms of market cap, right? Immediately, the instinct of people like myself is, let's apply that model to two-wheelers and see somebody who will disrupt the two-wheeler market, and would that be the same? And Tesla is fantastic. They also said that, how does distribution matter? I just go on the net, right? So the distribution models have also changed. I don't need agents. I don't need showrooms. I'll just talk about this on the web, make a lot of noise, put out some YouTube videos. People will buy my vehicle because it is disruptive and it is superior, right? In the two-wheeler market, it's very easy to adopt the same thing, but is the technology amongst the two-wheeler players really disruptive? And I think that's the question. Is it disruptive? Is it incremental? If it's incremental, your Bajaj Autos and Heroes will win. If it's truly disruptive and the battery technology they have is completely different, the likes of Ola, Ather, etc., then they'll win, right? But you need to make that judgment call, and that's not easy unless you actually get into the science and you do a lot of homework. So what I'm suggesting is that don't lay too much store by experience. You've got to track what's actually happening, and you need access to depth of insight in that sector. You need to work with outstanding entrepreneurs. And you also have to have breadth, because often disruption is coming from somewhere else, right? And if you think of timing, I mean, we all talk about mRNA in terms of vaccines and, how quickly they were all approved. Does anyone know how long, this mRNA technology has been around? This mRNA technology was proven, I think it was, I'm not certain, but it was either in Kansas or it was done in mice. This was used in mice in 1990 and proven correct. And then people struggled to use the same technology in human beings. And what they were trying to do was actually use this technology to alter normal cells to make them stem cells. But it was provoking a very strong immune reaction. And it took a long time for people to figure out that, what? If I'm provoking an immune reaction, why don't I use this as a vaccine? Right? I mean, so, that whole thought process, but it's a 30-year-old technology. It didn't happen yesterday. Now, do I think that it's a very powerful technology? Because if your DNA gets transcribed into messenger RNA, which goes to the ribosome, and proteins are transcribed out of that, right? And which means that you now know the technology to make whichever protein you want, transform a normal cell into a stem cell. And if you can know how to make proteins, then you can make proteins inside a cell instead of giving a pill to a person, right? And you don't know how not to get it inside the cell, because that pill might work, but your absorption system, your digestive system might break it down. Even if it doesn't, it might get into your bloodstream, it might get diffused, but it may not go inside the cell. Now you short-circuited so much, right? So there's tremendous opportunity. And this is what I'm saying, that the whole world is now going into a stage where it's not just in healthcare. It's across sectors and across segments, where there is going to be so much disruption that one should not be looking back, one should be looking forward. That's the short message I have. I made a lot of comments, and happy to jump into Q&A. Yeah.
No, I think truly amazing, Rahul. And while you will not admit it out of your modesty, you kept using this word luck and serendipity multiple times, and there's just sheer, modesty. I would not like to believe that it's all luck and serendipity which has got you over here. But I'll flip the question for you, that beyond luck and serendipity, what do you think have kept you going, and what is in it for a successful investor to make sure that, it's not always luck? What are the other qualities that you kind of find very, very essential for an investor to have, a balanced journey throughout all the volatility over years?
So one of the first things, I mean, to my mind, one of the most important skills an investor must learn is the confirmation bias, right? It's a human nature thing, right? We're always looking to confirm what we know to be true.
Correct.
And it's very hard to consciously look for data which contradicts you. But if you don't do that in a very systematic, structured way, then you will always get lost as to thinking that, you know what, this is, and it's that curiosity and that conscious effort to not get caught up in the confirmation bias, to me, that's something which is very important. The other thing which I was very lucky with, I mean, like very early in my career, encountered people who were very, very bright, right? And I met two kinds of people. One who were very bright, but I felt in a few months that I knew more about my job than they did, and they were there for 20 years plus. And that was, and many times I had to post meetings, go and correct them. And, you know, say that it's wrong. And it was very disturbing to me. And I thought that, my God, one day I'll be in this job for 20 years. And some kid is going to come and tell me that, you know what, you got this wrong and you got that wrong. And I thought about it and said, why did this happen? And then I figured that in spite of the fact that, you know, the people I'm talking about had incredible academic credentials and everything else, they felt that their education stopped the day they passed out of college or, you know, finished their MBAs in this particular case. They thought that they had sort of earned their stripes and that was it. And they didn't need to relearn and re-educate themselves continuously. And, you know, and that was very disturbing. And I said, you know what, I'm not going to have some kid come up to me when I'm that age and do this to me. So I'm going to, what advantage do I have on them? I'll have time on my side. So I have always stuck to the rule that, you know, every day you must learn something more. And that's helped me considerably, I would say. What else? I think the other thing is that you increasingly learn that you spend time, you're motivated to work with companies where you like the entrepreneur, right? If you don't like the entrepreneur, I'm always willing to suffer geniuses, eccentricities, rudeness, tantrums. I have no problem. I am not, but geniuses are very few. I'm not willing to tolerate that with everyone, right? And so what I want then is congeniality. I want someone who's positive, constructive, right? But I want someone who's very passionate. If you must work with people who are passionate, who have a can-do. And I don't care if a guy's failed 10 times. As long as he has the drive to try the 11th time and get on with it and, you know, keep experimenting. It's that sort of obsession to, you know, make a difference and get something right. And I think those are characteristics, again, if you work with those kinds of people, you will usually end up getting quite lucky. So I think they kind of, and that would be true in terms of your colleagues, in terms of your partners, in terms of your investee companies. I think, you know, the broader, the more within the ecosystem of outstanding people that you work with, you know, your probability of serendipity keeps going up. So I think that's another essential part of it, I think. Just on a lighter note, I should say that one of my warning bells in companies, etc., that I've noticed is that anybody who has a lot of signs, visible signs of being ultra-religious, I find they usually make very bad partners because they'll do unfair things and they will justify it because of some higher cause. So usually my sign to run from a company is if I see too many signs of, you know, a lot of, and look, they are, you know, we can keep talking about this a long time, but if the audience has specific things, I'm happy to discuss.
There are some invaluable lessons. I think these are really interesting, and I would love to keep talking about it, but I think there are more other questions also. So one question before I move to audience question answer and all, you know, again, 4 decades of investing experience. You've seen the highs and the lows, the thicks and the thins of investment. Let's talk a bit about asset classes. Like, how have you moved your asset class choices, and how do you adapt to asset classes? You did speak about it in brief about traditional businesses versus startups and disruption and all. But today, how do you adjust to something like 4 decades ago was completely different? The fundamentals have changed. I mean, profit and loss are not being talked about anymore. Profitability is, sort to say, old-fashioned, where people are putting more emphasis on GMVs and revenues and traction by burning money. How do you adapt to this, and what's your view on this new way of investment or new economy startup culture, so to say?
So look, to my mind, understanding the new economy, understanding the disruption, understanding the sources of disruption, understanding how things will play out. And I think there are a lot of fundamental structural changes which are taking place. And, changes in one place are going to change things dramatically in other places. And, I think we could have separate sessions on each industry and where that can go to. But as far as investing is concerned, what are you trying to do? You're trying to take your 1 unit of purchasing power today, and that by postponing that purchase today, you want higher purchasing power tomorrow, right? Which means you want the relative value of what you own to be higher tomorrow relative to today. Now, one of the things that only way that can really happen in a world which has so much of debt. If you look at the US, you look at all of Southern Europe, you look at Canada, you look at China, you look at Japan, you look at Australia, you look at New Zealand, and you look at debt to GDP ratios, they are in completely uncharted territory. Now, Greece has a history that, they've been in default in the last 2,500 years. More years they've been in default than not being in default. But if you look at the point at which they went into defaults, and you look at, Rogoff and Reinhardt had done a study saying that when debt to GDP goes over 90% of GDP, growth rates tend to slow down. And then they revised it, and some studies, they had some criticism, they revised it to 120%. But most of these countries I named just now, the debt to GDP is close to 300%. Right? Now, in this environment, for these countries to be able to service debt, there are 2 ways. Either they declare bankruptcy, default, and face the pain. That's what the Austrian economist school would recommend, that you just face the pain, say that, we've goofed up, we can't service this. But that's very hard in a democracy, because the minute you do that, there's tremendous amount of job losses, there's loss of wealth, there's, now in a purist capitalistic system, you're going to throw up factor resources, you're going to open them up, there's going to be factor mobility, they will get redeployed in productive ways, and things will bounce back faster. But you know what? Whichever politician takes that decision, his career is over. Right? And what I have seen in my life so far is that most politicians are very self-serving. So they're not going to go down this path. What they're going to do is they're going to keep interest rates and cost of capital below the cost of inflation, so that the real value of debt keeps on coming down. Now, in that scenario, if people are predominantly saving money in fixed deposits, PPF, government bonds, corporate bonds, their purchasing power is going to structurally keep declining. And this is true not only in India, but I would suggest that if you think of it on a structural basis, over the next 20 years around the world, this would be true. Which means that it shortens your choices to equities and real assets. Real assets being real estate, commodities, any of that ecosystem. Now, the problem with commodities, etc., is that how does a normal individual go and buy commodities? It's very tough, right? You can't sort of say that I'm going to buy 2 tons of copper and keep it in my house. I mean, it's just impractical, right? Now, if that is the case, that real estate you could do, but the unit size is typically high, it's illiquid, and most governments, for whatever reasons, have things like stamp duties, etc., which means the transaction costs are high. Right? Going in, going out. So it's not that investor friendly. Now, people end up making a lot of money in real estate, because it's so illiquid and the transaction costs are so high, they end up holding for a long period of time. So they think they made a lot of money, but if you break it down to IRRs, they're typically not that great. Which leaves you the equity asset class. Now, in the equity asset class, that is what's going to generate the highest amount of returns, I feel, over the next. Cyclically, I think real estate markets in India are probably undervalued at this moment because you've gone through this, brutal squeezing out and clean up for almost the last 12 odd years now, right? And so, you're due for a cyclical rebound, especially because the structural drivers of growth are still very strong in an Indian context. And they are different markets. They're different. If you look at government policy drives, real estate markets very significantly. I mean, if say someone like a city of San Francisco has, about 1 million inhabitants. The city gives permission for 6,000 new units to be built every year, right? And, more jobs are being created, more people are moving there, which means real estate prices have to go up. I mean, and then what do typically governments do around the world? I mean, at one side, they squeeze supply. They're not giving FSI, not investing in infrastructure. On the other side, most governments around the world, including our own, subsidize housing loans and, the purchase of housing in some way. So you're increasing demand on one side, squeezing supply on the other side. You're going to have, profitable markets. In an Indian context, there is one other risk that a lot of times pricing is already being determined because of shortage, not because of the value of the underlying commodity. And in that situation, you don't want to invest in real estate. And I would point out that, markets like Bombay may be in that kind of category where you're paying a shortage premium. You're not paying for the value proposition of what you're getting, right? But in equities, you can go into, the larger end, the blue chips, etc. Or you can go into more illiquid companies, or you could get in the disruptive end.
Right.
The problem with long-term investing in equities, and this is again a big problem, is that with all of this innovation, which, we saw that in a positive light, from an investor's perspective, there's also this disruption. So the same company which you thought is going to give you tremendous returns over the next 5 years and 10 years or 20 years may get disrupted. So you need to be very conscious of the fact that technology risk, which was taught as a theoretical concept, during our MBAs, that's far more real than it's ever been. And I think that people underestimate that risk.
Agreed.
And the big challenges, even in early stage startups, etc., and people ignoring profitability or short-term or path to profitability and basically discounting 10, 20 years down the line, are, to my mind, very often underestimating the risk of the disruptor being disrupted, right? You might see this, tremendous cash flow 15 years later, and you might be willing to pay for it today or 10 years later. But the real challenge is that how do you know that 5 years later that disruptor will not get disrupted?
Yes.
And, so you've got to understand which ecosystem it's operating in and what the probability of that is, and then, appropriately discount that present value of cash flow. But ultimately, if your $1 of investment is not producing $2, $3, $4, it's not a good investment. And I typically have found that in previous market cycles, when people move away from fundamentals of cash flow, looking at cash flow and cash flow based investing, and new terminology creeps into the investing world. I remember eyeballs is a big one, right? Nowadays you talk about GMV, GMV1, GMV2. I mean, all this new kind of, jargon starts creeping in. You know that something's not quite kosher and something's not quite right. I mean, you've got to be able to reduce disruption, innovation, superior value proposition, ultimately into cash flows, and you should be able to discount it. Not that hard a concept, but you need that discipline, is my view.
Amazing, Rahul. Some really serious, in-depth thoughts. And I realize I'm standing between you and a barrage of questions that I have. So in whatever time we have, I'll try and pose some unique questions to you. I'll start with one which I had, and an investor also has, audience also has, is tell us something a bit about the Barings journey. I mean, from the first fund in 1998, how did Barings India happen, and what's the thesis that Barings follow? When you balance both public market investment and private investments. Maybe quickly, whatever we can discuss about it.
look, when you manage third-party money, you have to be cognizant of what your investor base is and what their risk profile is and what they want, right? So you don't necessarily, I think a lot of that ends up in what is called satisficing rather than optimizing. And I mean, if I look at our own journey over 2.5 decades, our IRR in early stage investing is 44%.
Wow.
IRR, which means our annual returns, and though the volatility of those returns is high, right? Logically speaking, all I should be doing is that. But I invest in public markets. Our IRR over the last 25 years is 20% per annum. Now, 20% per annum compared to what public markets have delivered is more than double the average what the public markets have delivered. It's very good.
Correct.
But if I can do 44, why am I doing that, right? Because I have to balance considerations like liquidity. I have to balance considerations like when people will want their capital back.
Sure.
I have to balance risk. Often factor risks get concentrated in the more private markets and the liquid markets. Often bubbles form. When in shallow markets like India, something becomes too popular, it typically becomes mispriced, right? And so there is a very strong herd mentality that investors have, right? Uber made money, so everyone wants Uber of everything. But if you look at the Uber of everything else, has it really made money? I mean, I know Uber did $100 billion, IPO when they went IPO, but have others really made money? No, right? So you need to be a little cautious and smart about these things. So you need to balance risk. Risk tolerance and understanding risk and risk metrics, it's less important for a personal investor, though, in terms of the pressure, as they are not fiduciaries to other people. We are also fiduciaries, right? So it's not necessarily, I might have a much higher risk appetite, and I've been told often that I do. But when I'm managing someone else's money, I want to first make sure that that money is safe. I'm going to get that capital back and then try and generate alpha on top of that. Now, we've done extraordinarily well in terms of our alpha per annum. Every single year has been more than double of what the average market return has been. So, our alpha itself is very high, but it's something that one needs to calibrate. One needs to make sure that one is not taking too much factor risk. And I'll give you a sense of what the trade-offs are, right? One of the things with early stage investing, and it's a very simple thing. Something is going to be really big. Was it apparent that a Flipkart would be very big? It was very apparent. Right? Were they taking regulatory risk? They were, in terms of interpretation of, whether foreigners are allowed to invest in certain sectors and it was multi-brand retail or not. It was an interpretation. Now, if it's your own money, you can be, much more ferocious about putting out that capital. If you're managing money for someone else, can you take that risk? Right?